with because it's dated. It's time for the product to be turned. And it costs a lot of money to turn that product. And so I think that it's inherent upon myself and my side and representing landlords is to set, while the market's coming to us, I think we have to set really good expectations because while Dave and other tenant rep brokers are representing tenants, the tenants still feel that they can leverage you or your space against another space in another market. In the case of Sorrento Mesa, yes, the vacancy is 4% from a Class A standpoint, but when I'm negotiating and trying to push rents there, it's very easy for that tenant to go wind up in UTC and do a deal with another owner because that owner is more motivated to get some occupancy because of the vacancy, the vacancy difference in 20+% vacant.
Yeah, I think what we have to be cautious of if you're a Class A landlord or you own space in Del Mar Heights is getting too far ahead of the market. And I see some of that happening right now where Class A landlords are saying, gosh, Sorrento 4%, so I'm going to raise rents to 2.25 plus electricity, or Del Mar Heights, pretty much every asking rent's above 3 now, which I don't get. But what we do know is that tenants in San Diego are fickle. They'll move for a dime. They'll change submarkets for a dime. They'll go from an office building to a flex building for a dime. I mean, they're just crazy, right? And I think it's because it's their money. These aren't corporate headquarters of multi-billion-dollar companies. These are private businesses or venture-backed businesses, and they have a nature of watching every penny. It's just sort of how they're hardwired. And so when the spread between Class A and Class B is thin, everybody, of course, is going to go up market. But now as landlords try to raise that spread, you're going to see those Class A tenants start to bleed back to other alternatives, or they'll bleed back to other submarkets. I've had 2 meetings in the last 2 weeks in Del Mar Heights with tenants that are looking at, when their expiration happens next year, having to pay well north of $3 a foot, and they're currently paying 2 something. Well, they'll be moving out of Del Mar Heights most likely. They're saying, okay, what's happening on the 15 corridor? What's going on in Sorrento? These freeway exits aren't that far apart. If you think about Del Mar Heights, Torrey Hills, Sorrento Mesa, and UTC, it's 5 freeway exits from north to south. It's a joke that we even have them as different submarkets, but we work in these little micro pods here, thinking there's extreme dynamics between one and the other, and I'm not sure the premium of $1 a foot or $1.50 to be in a Del Mar Heights building versus the best product in UTC is rational. I don't know that really holds. So I think you're going to see this push and pull. You're going to see landlords trying to push rents in certain product types in certain submarkets. You're going to see tenants pull back, and I think that's where we find the equilibrium. I think that's the dance that we're all doing right now out in the marketplace, is trying to adjust to where those new expectations should be, and where are the tenants going to go? What will the tenants tolerate? Because to tenants in San Diego, it's still a recession. This ain't over. Okay, it's still hard to raise money. It's still hard to start a new company. It's still a tough economy. And so, to the extent landlords get ahead of the tenants, I think you're setting yourself up for a problem.
Well, to that end, 18 months to 2 years ago, both tenants and landlords, we were one of them, everyone was just frozen. I mean, yeah. You would do a month-to-month deal, you'd do a 6-month deal. Everyone just tenants wanted to maintain their occupancy because they didn't want the cost of moving. They didn't know if they were going to be in business 3 months from now. And landlords obviously wanted to keep the occupancy, and everything was about economics, no question. And every phone call we get, what do you know? It's all about economics. They don't care what the building looks like, whether there's amenities or whatever, and obviously we don't have a tendency to believe that. But I do think as we come out of this recession, at least we're betting on the fact that quality matters, amenities matter, conveniences matter, location matters, and not just because it's a nice place to work, but it makes employees more productive, it makes recruitment easier, and it makes retention easier. And at the end of the day, at least we believe that's really important to a business. And maybe not in the past few years because you were in survival mode, but I think going forward, at least that's what we're betting on. What's your thought, Chad?
Well, I think there's a dichotomy going on. And where we're at in the market, I think part of that's true. When we take our tenant roll, the tenants that are in the market today, I'd say 25% of them, I don't know where this comes from, but 25% of them are the cheap tenant. And they all say the same thing. I want a $1.50 gross deal. I don't know if that's a tenant rep driven deal or what the basis of that is, but you got 25% of the tenants, cost effective, cash flow driven. On the flip side, probably 25% of the tenant roll is, you know what, I'm willing to pay a fair price for quality, and I want to lock in a good deal. And the other 50% falls somewhere between. But what you're hitting on, I think, is where this market's heading. And I think a couple creative owners, Dan Ryan, Kilroy, others, are starting to realize that if we continue to build the same product, and I would argue, the last couple cycles, there's some great real estate built, but fairly similar. It's going to be hard to push price because it's just location, and location can equal price. We got to start delivering product that is more mixed use, quality of life. I mean, we're going to start seeing some projects like that develop, and we can wait for the tenants to drive that demand, or we can kind of be proactive and go, this is what I think these people are going to want, and I think that they'll pay a premium. So.
Hey, John, I think there's another part to that equation, and that's landlord specific as well. It can be the amenities, but it can also be all about the landlord. And that's about the flawless execution of certain landlords. That's about offering up the type of environment you're talking about. But it's about, security for that tenant, your clients, that they're going to have, delivery of that product, that they're going to have a project that's well maintained, that they're going to be able to operate in the right kind of environment. So, I think the landlord is just as important because we're starting to see transactions where there are landlords that can't fund TIs, or it's going to be questionable here going forward. There are going to be lender restrictions there, so I think that that's going to be an important part of the equation as well. And talking about the tenant profile that exists out in the marketplace, that tenant profile has changed, and the demand equation has changed. I mean, Dave obviously sees this as to what industry groups are most oriented toward amenities or location or whatever, but from our world and real-time stuff, on the demand equation alone, I mean, we're tracking more demand right now than we have in 5 to 10 years. And so, I think that's going to drive, some of these companies that are out there want those amenities, and I think we'll start to pay up for some of those because there's starting to be competition for space. I mean, I've had, a few instances recently where we've got tenants that are, I don't want to say a bidding war, but, you and I had an experience here recently for 100,000 square feet where we ran into that. I mean, it's been a while since we can say that, and I think that we're starting to see that in the most quality assets, that those tenants are appreciating those landlords, those amenities, those environments that will allow them to grow their business going forward.
I think there's a very good indicator when the market is turning when you start seeing some build-to-suits. And we've seen several, obviously the GSA and the FBI build-to-suit. You have LPL Financial Services out there for a build-to-suit. Advanced Biohealing out there for a potential build-to-suit. When you start seeing the build-to-suits and you statistically look at the numbers, according to our information, 25% of the current vacancy in the office market right now is space less than 5,000 square feet. Conversely, there's only 11 opportunities available 100,000 square feet or more in the market.
But there's what, 2 tenants, right? So I mean, the challenge is, big space is in short supply, but so are big tenants. And I think, if every year 1 or 2 transactions gets done, that's still, the math still works out to a lot of supply, right?
Yeah,
you got to look at the number of deals done though over 120,000 square feet, which is a pretty big tenant in San Diego.
Just office.
Well, office, corporate,
everything.
Yeah, office, corporate headquarters. Yeah, we've been clipping off at about 7, almost 8 deals a year. That's almost 2 a quarter. So that's pretty substantial big tenant demand, But you'd expect to see that as you pull out a recovery, right? You'd expect to see the Mitchell-type transactions where corporations go, I'm going to right size, I'm going to get under one roof. I think there's going to continue to be demand for that type of space.
Yeah, what worries me though about the build-to-suits, because there's a bunch of them happening, right? ISIS, FBI, more, is people forget about the net effect of that because you bring more product on the market
True.
and you leave behind 3 buildings or 6 spaces, or, I mean, it's not, I don't think build-to-suits are good news. It may be an indicator, but yet it does add to the overall supply of second-generation space too. So there's a byproduct there that's
Yeah, and
not
I agree.
good.
I agree with you. But if you sit back and let's just use LPL for, as an example. So LPL, if they do this build-to-suit and they do 400,000 square feet, next to Hines. So the majority of the product they occupy is on Town Center Drive, with Arden and with the Irvine Company. Okay, so it takes 24 months to deliver. They're up. So 24 months from today, where's that market? Where's that market? Where's that recovery? I mean, that's 2 years out. Most of us are at plus or minus a 5 today. We haven't got to where we're going to be from a year from now. Where are we going to be 2 years from now? I think that certainly people like the Irvine Company and the vision that they have and the product they have and Kilroy's and Arden for that matter, the product that they have and the vision that they have and the capital that they have are going to be able to turn a product that is going to lease. And because it's good real estate and it's a good location.
Well, but to Chad's point, right, you have this generic 2-story Class B office space all over the county that sort of prices as a commodity, and that is exactly what Town Center Drive and Eastgate is. So if there's a big sucking sound out of there by LPL going, you already have a bunch of product up there, direct and sublease. I mean, it's half a ghost town as it is on Town Center and Eastgate. So my concern would be, what does that do to the region if that inventory floods back at the same time? I don't think it's good news, is my point.
It's going to be a problem. I think in total, I think there's about 1.5 million square feet of vacancy or near-term roll in that Eastgate Campus Point area. And that's, in the corporate headquarters world, that's the Del Mar Heights of corporate headquarters, right? It's very comparable. So it wreaks havoc on Kearney. It wreaks havoc on, some Class A space in Sereno Mesa, UTC, and in Del Mar Heights. So that's going to be a problem from a price standpoint for that corporate headquarters space for a while.
Yeah, because one thing I do know about Irvine and Kilroy is these guys play to win, right? I mean, they've got deep pockets, they've got a lot of capital, they'll do the right thing with the real estate, and they don't like vacancy. And they're going to come in and be very aggressive and disruptive, I think, in the region if that happens as a group, including Arden too. All that product comes back, I think it's a problem.
So if you happen to own some product on Town Center Drive, is the bar open? Would you, and I'll throw this to Chad and Eric, if you had a multi-building user there, would you try to accumulate 100 or 200,000 feet you could put together in a campus, or would you go advise your client to lease 20, 30, 40 at a time? I mean, or should we be attacking bigger users in a couple years or smaller users?
I think unfortunately you got both, right? So you have a lot of rollover in Eastgate, and you have the 20 and 40,000 square foot breakouts of space, but you also got Qualcomm in the near future vacating closer to 200,000 feet. So, the beauty of specifically that product type that you're talking about, your situation, I think there is you control for a while.
It was hypothetical, by the way.
Yeah, we know.